Hello, I am Steve Spencer, a partner at SMB Capital, a proprietary trading firm in New York City where we trade stocks, futures, and options. In today's video, I'm going to talk about getting short a strong market. Stepping in the path of stampeding bulls can be tricky. If you want to learn how to do this without being stomped, stick around. Before we get started, I wanted to remind you we have a 2-hour free workshop. You can sign up for that clicking on the link above. In that workshop, I spend 30 minutes going over our proprietary stock selection process, where we find the most in play, lowest risk, highest reward stocks to trade each day, and then also 3 of the setups that we use on our prop desk in New York City. Okay, let's get started. So recently, the market had a strong rally from the March low to the May high. It did this without taking a breather. It was fast. Here's the chart. So looking at the chart, what you can see is over a 2-week period, the SPY sold off from 289 all the way down to 274. And then we gapped up the following day and we started a very strong, very fast uptrend, erasing that entire 2-week down move in 4 trading sessions. When that happened, I started to think about getting short. And here's why. My expectation is that the market will start to find supply. When supply starts to meet demand, price increases begin to stall out. And quite often, the stalling out price will attract more sellers, and we will get a pullback. Let's take a look at Monday's price action. We opened above 289 and proceeded to trade up about $1.50. The market put in a top at noon, and then we sold off the rest of the afternoon. This was different. On the way up from 274 to 289, we did not see sellings in the afternoon. We did not see market clues at the low of the day. This put me on alert to look for a shorting opportunity the next day because this was different. When we want to put on trades in the opposite of the most recent trend in the market, we look for something different. And that's what we had Monday afternoon. The prior 5 days, there was no afternoon selling. So I'm prepared to be short the next day, regardless of whether the market gaps higher or lower. So let's take a look at what happened the next day. What we can see is, after closing at 289 on Monday, we gapped up to 291 on Tuesday. And as I said, I was prepared to be short whether we gapped higher or lower the next day. It just changes the approach a little bit. So in the case of gapping higher, what we're going to do is work with the prior day's high to get an idea if sellers are coming in and downward pressure will start. So I've labeled this intraday chart for you. What you can see is right on the open. I had circled the area at around in the first 10 minutes where we were above 291, and then we very quickly sold off to about 290.60. So we came off about 80 cents very quickly, and I labeled that 1 because that was the first signal to me Tuesday morning that this could be the beginning of a larger pullback. And in fact, I tweeted out at that point, short SPY, let's do this, a little smiley face, because that was my signal that it was time to start getting short. And here's how I define the trade. We sell off hard, that big red bar. We pop back up, always want to short into a retracement. When we see the first sell signal into 291 is the most obvious price. Whole numbers, there's always supply there, so it pops back up, starts shorting into 291. And I know I'm wrong if we take out the intraday high. This is very little risk. This is 30 cents of risk. And if this is the beginning of an intraday downtrend, we're going to see $2 to $3 potentially of downside. $2 of downside is 289, the level I highlighted in the first chart. That's where we sold off from in early May and mid-May. It's where I started to look for a potential failure over the last few days. And when we come back into it, it might act as support. It was prior resistance last month. It may, now that we're above it, act as support. So that's $2 of downside, and we're putting on a short trade into 291 with 30 cents of risk. Now, after that first down move, we start to move sideways. The next thing I'm going to look for is we break below that pullback low from the initial big red bar. Once I see that, then I have the beginning of a trend. and I'm going to make a decision at 290 when we've come off $1. I can cover a percentage of the position. I can cover 25, 30% of the position. That way I know under no circumstances will this be a losing trade. Or I can wait for a full-on reversal and cover in that situation as well. It's really going to depend on the individual discretionary trader how to handle it, but understand once you've taken out that initial pullback low that we have the beginning of a trend, and we're just going to stay with the trend until that intraday trend breaks, or we hit our downside target, ultimate downside target, which in this case is a 1% move. A 1% move takes us into the low 288s, and you can kind of see at the right part of the screen there, that's where we finally started to bottom out. The third, number 3 that I circled on the intraday chart is, that was the prior days that acted as actually, if you can go to on Monday, when we topped out and we started to pull back, we consolidated, then broke down and put it in a low, and we moved back up and we failed. And so I'm using that 290.50 from the prior day, and then also intraday on Tuesday as well. And then you can see when we trace back up to it, the third point, we failed there as well, and then the trend was strongly in place. We eventually took out the 289, bottoming at about 1% from the high. And so that was the trade. Now, I want to make a couple of points. Number one, and I've said this before, I probably said this in other videos, shorting an overbought market that's been trending higher is not the same as getting long an oversold market. When the markets move down like it did a couple of weeks ago from 289 to 274, my thought process is quite different. Markets that are oversold, you tend to get these V bottoms, these strong snapback rallies, and then I'll look for a larger move. If that snapback holds, just continue to look for us to trend higher and look for a bigger move. When a market is trending up and volatility is low and we get overbought, I'm looking, for the most part, what I'm looking for is just, a standard, as I said, a 1% pullback, and then the market might start to just consolidate and resume that uptrend. And if we zoom out and we look at over the last few days, here's a chart that we can see going back all the way to Friday and then this week. You can see after that intraday downtrend, we basically started to move sideways. Today we gapped up a little bit, but it's a really tight range. And what we're doing is we're digesting that big uptrend from the mid 270s up to 290. And once that move has been digested and the longer, higher time frame trend starts to catch up, then we'll look for the uptrend that started 6-7 days ago to resume. And if we take out the high from earlier in this week, I'll look for the market to trend higher. And so I wanted to kind of just step back and give you that bigger picture view. But bottom line for this trade is it's okay to overshort markets, overbought markets, but you have to have a good understanding of the basic setup. You need price confirmation to become more aggressive. And we had that price confirmation once we had the initial hard down move, we held below 291, and we took out the intraday low. Then you could become more aggressive. And once the trade is working, stick with it until you hit your price targets.